Good afternoon. So we wanted to put together a video here, talk about the indexes, where we stand, kind of catch up with what we were talking about in the last video, what has transpired since then. We'll look at the weekly, daily, 195-minute time frames for the indexes, and then kind of manage expectations for the coming weeks. We do have earnings season. We're in the midst of it as we speak with Tesla, Amazon, Microsoft not Amazon, but Google and Meta all reporting this week. So that's obviously going to really cause some movement in the markets. And then we also have FOMC Day, I believe it's next week, along with Apple earnings. So a lot of moving parts here. I want to talk about the gold and silver shorts. They both got hammered pretty hard over the course of the last 24 hours. We'll look at the technicals there and then kind of talk about what the potential catalyst can be behind that selling, and then wrap it up by looking at a couple earnings gappers with some short side ideas being the JP Morgan, Netflix, and Las Vegas Sands. And then my favorite chart right now in the market, which is United Airlines for potential long setup. So without further ado, let's just kind of dive into the QQQ chart. This is really where I'm mainly focusing, is the QQQ index, NASDAQ 100, just because most of the stocks I trade are moving based off of this index. And you can see everything is kind of playing out exactly as how one would expect if a market is going to move into a full-blown market correction. That being that sequence that we've talked about several times before. You lose that uptrend support, and then you will then shortly after that lose the 50. When you get that sequence that plays out, it's generally the precursor of what's to come, and that is a more lengthy true market correction, which is when price falls 10% or more off 52-week highs. We're currently at about 8%, which would be defined as a deep pullback. Anything contained between 3 and 5% is a short-term pullback, and usually you're finding the support at the 20 EMA in that case. Anything beyond 5%, you're kind of moving into deeper pullback territory. Finally, anything beyond 10% is what is defined as being a full-blown correction. So we aren't quite in that correction territory yet, but it does look to me that we're more than likely gonna enter it. So this was the first. We'll look at the weekly here, right? You can see we had our first leg up starting in 2020. We then had our what's a pretty strong move higher, right? It's about a 49% move, and then if I go over here, you could see that same sequence played out. And don't take my word for it. Go back and study previous cycles. You're going to see it, it happens every time. So right when that sequence happens, right away the market's likely to move sideways for several months. Don't trust moves. Be very cautious. So we then corrected about 12%, right? That played out throughout about 3 months worth of duration before we finally recaptured that 50. We broke the downtrend support, so it's kind of the inverse here. That's our signal that the market is moving back into a positive environment. And then we had a nice, from lows to high, about 32% move. So right now, we're having our first leg down of a short-term downtrend. If we go to the 195-minute, just to review what we're looking for, we're using stage analysis on the short-term time frames, right? So you have your multiple stages. This was the stage 3. If you don't know what I'm talking about, I encourage you to go watch the last video I put out. I talked about this in depth. So really all we're looking for here is the first retest of the falling 30 moving average. And then we're going to, generally speaking, you're going to get rejected off of it, put in some kind of lower high, and then you're going to have a very clean pivot point to play. So we're still waiting for that first point of contact, and it looks like it's not going to happen for maybe another week or so at the very least. But we're really just looking for that actionable pivot like we had back here, right? There were several of them. Let me see if I got it saved. There we go. So, right, we're just looking for that first point of contact, which we got right here. Well, really, we shot above it. We then pull back. We put in that lower high, and then you have a double bottom neckline to trade. We go long here, right? So first point of contact, we pull back, higher low, and then we make the higher high here. So double bottom. So that's really what I'm looking for. I just want a double bottom to base to build out, that will be our reversal pattern. So it's not enough to say, oh, we're in the extremes with regards to breadth indicators or sentiment. Fear, greed is down to 10 and the low is 0. It usually fluctuates between 0 and 100. Even if every indicator in the world, whether it be sentiment, whether it be a market internal or technical, having it in the extremes is not enough. There needs to be some kind of reversal pattern that builds out that you could trade. That's what would validate buying in the extremes. It's not just, okay, we're really oversold into potential support level, I'm just going to buy here. That's how you're going to get hurt really bad. So what we're doing right now is we're being patient. We're waiting for the reversal pattern to build out. This could very well just be a bear flag. You can see the selling has really pulled in, or the buyers have not really been able to have any kind of meaningful push higher. So this could be build out a little base and then we break higher after the short-term moving averages catch up, or this is going to be another day or two pause, and then we maybe even just tomorrow we stay in this range and then break down. It would just be a bear flag, right? Very strong move lower. Look at the volume. We're starting to potentially build out a flag on light volume. So this is like a textbook short. So with that said, make sure you have your list of potential short setups ready if interested in shorting the market. Or you could just look to go long SQQQ, which is your ProShares Ultra Short QQQ. So it moves inverse the Qs. If the Qs move lower, this breaks out. So this could be, I'm not sure why I have this line here, but I'm assuming, maybe it was price targets or profit targets. But this can be a potential bull flag building out and breaking higher. So looking at the Qs right now, we're waiting patiently to see if this builds out, if it's being a bear flag that's building out, or if it's going to build a multi-week base like we had here, and then we're going to, play based off of whatever our hand is. That's all. So just being patient here. Now we can look at the SPY real quickly. You can see the SPY is in kind of the same exact position. We pulled into this gap support, and now we're kind of just moving sideways. We're moving side today. We're up about just less than 1%, and we're up on less volume than that of which we pulled back. So right now, price action looks very bearish. We'll see how that things play out when big tech report this week, because that's going to really affect the sentiment in the market. Is it going to help reignite to the downside? Is it going to bring further pessimism to the markets, or are big tech earnings going to be well received? It's very important. So because if big tech earnings are poorly received, and they're considered the safer risk assets, think of how all of the higher risk assets, growth stocks, small caps, micro cap names, Bitcoin, the highest of risk assets are going to be received, right? They're going to be dealt a more harsh blow than that of big tech names, because this is generally when a bull trend is reigniting, like we saw when we were starting to break out of this corrective base. It's big tech that are going to move up first, because they're the safer trading vehicle in many institution eyes and investors' eyes. And then once that risk appetite really starts to move, then you start to see inflows into the riskier names, growth stocks, small caps, micro caps, etc. And then they're usually going to be the last ones to go, big tech, because those riskier assets are going to be the first ones to fade as well. So what I'm trying to say here is, if big tech earnings are poorly received by the market, I'm expecting for this correction to have a longer length. Think another 2 months or so, because that sentiment is likely to stay weak. Investors are likely to be in that pessimistic mindset until the next earnings season, which is the next opportunity for that to be revived. So that's why earnings season this week specifically is really important to me. We have Apple next week, and obviously the Fed next week, which has been increasingly hawkish in their statements. You even have the most dovish of the Feds that are now talking about there's definitely greater concern than there was, let's say, 2-3 months ago when the first CPI data came out that was hot. Now that we've had 3 consecutive hot prints, it's something that no longer can be ignored. So they're talking as if there's a potential that they're willing to, fight inflation, potentially raise rates if need be. You look at the 2-year yields. This tells us if the market's pricing in more interest rate hikes. So if we break out of this base, that'd be very bad. That would mean the market's now expecting us to get we're no longer even expecting rate cuts. We're actually expecting to increase, to get even more hikes, which would be very bearish, obviously. More specifically for IWM, small caps, and anything. So this is obviously important. This important chart here, kind of going to be a tell as to whether or not the market is expecting for us to actually get even more aggressive with the fight of inflation or not. So that's really one of the main reasons I believe that gold, let's just look at this chart right here. Gold and silver are selling off so aggressively today. The volume really isn't anything crazy, but there's range expansion here. You can see it's down about 2.9%, and the average daily range is 1.9. So there's clearly range expansion here. We're tinkering with that support line, about to break down. Now, as you guys know, I've been short this for quite some time, with the high volume closed candlestick really being the reason I got involved in the first place. That candlestick showing us the exhaustion in the trend. Now it looks like it's finally breaking down. We're going to see if we can make a meaningful move lower. But to me, this is what I would like to see this is the point in time where I would expect for us to really start to generate some downside momentum. So there's gold, and then there's also silver, which is the weaker of the two. You can see already broke through that support level. It's sitting on the 20 EMA as we speak. Once again, not anything too crazy with volume. If it were more heavy, the volume, I would be a lot more comfortable that we're going to get that follow through tomorrow, but it could still work. This is still actually pretty heavy volume compared to the normal. I was going back and just studying previous breakdowns from bases, and you could see that this blue line is where the volume is at currently today, and you could see that these breakdowns all had about the same amount of volume, and there was considerable move to the downside. Same here, and then same here. So I think that this could be a nice short. It's really the only high quality setup that I see in the market right now. I've seen for the last 2 weeks or so. So I'm trying my luck here, and we'll see how that plays out. So that's really the rationale for the silver and gold trade. They both have their high volume closed candlesticks, those heavy volume reversal candlesticks that tell us that there's been exhaustion in the trend. They've already had pretty significant moves higher, and now we're starting to see the bears really start to take control, and we're breaking down through key levels on with some range expansion, some bearish technical characteristics. So that is why we're short silver, short gold. We'll see how that plays out. Now, with regards to the post-earnings gappers that we're keeping an eye on, we got JP Morgan. So JP Morgan had earnings about 2 weeks ago? I think it was not last Friday, but the Friday prior. It gapped down, and now it's retracing higher. Not really ideal for me. I rather had, just moved sideways here. So there's really no setup there right now. But let's look at Netflix real quick. You see Netflix, this is better. So we gapped down. We had some follow through to the downside. Now what we would really want to do is just see it kind of build out this flag and then break lower. So we're short-term extended to the downside, work off those oversold conditions, let the short-term moving average just catch up, and then continue lower. So this is really a nice looking short, but it needs some time to build out. So maybe 3-4 days and then breaks lower. Not sure. We need to see how this builds out, because JP Morgan looked similar, and now obviously it had some follow through. I was hoping it just built out in this area, and it didn't. So will Netflix do the same thing and go from what could have potentially been a good setup to one that's not really as intriguing anymore? Very well could be. So Netflix, just one to watch in the coming days. And then you got Las Vegas Sands. You could see that they also had an earnings gap down, and now we're just kind of building out sideways. So heavy unfilled gap, sign of weakness, right? You have it, the earnings reaction. So obviously investors didn't like what they heard. So the sentiment has been kind of hindered because of that. And we have an unfilled gap as a result. We're a little bit short-term extended to the downside. You can see we're just moving sideways now as the short-term moving averages catch up. We're working off those short-term oversold levels, and we're kind of building out a bear flag. So it's the same deal here. If the market is having its next leg down, it looks like a nice potential candidate to consider for a bear flag breakdown. Let's look at the weekly real quick. So the weekly, it's also not extended at all, and it's right next to this. We're at a key pivot point. So one could expect that we at least move down here, another 3-4%, if not break down completely. But look at the volume. That's some heavy selling here. And that's on a very bearish candlestick. So this really does look like it wants to go lower. Is this in a stage 4 downtrend? Yeah, I think this would also push us into, actually this might already be in stage 4. I would have to look at it more in detail. But I think this is in a stage 4 downtrend. Yeah, we got the stage 3 top here. We break down to stage 4. We're basing, and so this would be a potential stage 4 continuation breakdown. So bearish chart for sure. And it looks great on the daily too. We're not extended on the daily or weekly. And despite the market being up a good amount today, Las Vegas Sands is up. It's got a little bit of retracement, not too bad. But yeah, so let's just keep an eye on this one, see if it builds out a bear flag. Ideally, if it does, it breaks down the next 2 to 3 days. So that's another name I'm watching for potential shorts. And then my favorite potential long is United Airlines, which you could see, we've already covered this in the newsletter, and I've talked about it in the live in the morning, but we had this earnings gap up, very powerful move higher, and we've yet to really have any meaningful consolidation. So we're looking to see how, right now there's nothing to do, right? We're going to watch it, and then we're going to wait until it starts to correct. It's going to have a couple days pullback. Does it build out a nice flag that we could use as a pivot point to get involved, or is it going to just completely reverse? We'll have to see. But this looks really good on the daily, and it looks really good on the weekly. If you just look at that volume, they liked something they were hearing, right? So this is really one of my favorite charts right now. I'm hoping it gives us that opportunity to get involved. We'll just have to wait and see. So that's really where the market stands right now. You have a lot of your risk-off assets moving sideways, just digesting, such as the dollar and the 10-year yields. You can see they're still looking quite bullish. So no reason to get very bullish here, especially considering at the same time the indexes are kind of just consolidating on light volume. So right now the charts have more of a bearish look to them. We'll see if that changes over the course of earnings week or the next 2 weeks and with the Fed. But that's really all I got for you tonight or today. So you guys have a good rest of your day.